Hi everyone, in this video series we are going to continue recording transactions. We are going to look at a specific company. We will, as I mentioned, record transactions, and afterwards we are going to do the closing entries, and eventually we are going to start building balance sheet and income statement. So it's a series of video lectures, and hence starting from this point is important. That said, let's take a look at our company. ABC Inc. is launching operations on January 2nd, and they are recording the following transactions. The first transaction is issuing shares, 5,000 shares specifically at $100 per share. What that's going to happen is when companies issue shares, they are going to receive cash, 5,000 shares at $100 per price. That's going to give us $500 worth of revenue, and at the same time we are going to increase contributed capital. Contributed capital is going to increase by the same amount. So when you issue shares, the equity is going to increase, and cash is going to increase as well. The next transaction, second transaction, is where company is delivering the services and billing the client for $10,000. And what that means is by the time the company delivers the services or products, they are going to recognize that revenue. So retained earnings is going to increase by that amount. And this may be a bit counterintuitive, because we think of, when we receive cash, it's revenue, but in accounting that's not the case. Cash accounting is not what we are after. It's practically when companies deliver services and products, that's when they recognize revenue. And they are billing the client, they haven't received cash yet, so they are going to increase their accounts receivables by the same amount. So accounts receivable is going to increase by $10,000, and retained earnings is also going to increase by $10,000. On transaction number 3, the company is collecting $5,000 cash for its accounts receivables. That means cash is going to increase by this amount, and accounts receivable is going to decrease by that amount. So one asset class is increasing and another one is decreasing. This is what you do when you collect your cash against your accounts receivables. The fourth transaction, we are given a lot of data. The customer is ordering a custom-made part. The part will be sold for $5,000 and it will cost $2,000 to produce. Customer is making an advance payment of $1,000 for this. So what's going to happen in the future is not interesting us. So we are going to record this part later. What we are going to record is this part here, which is company is receiving cash, recording $1,000, and since they haven't recorded or delivered the services, it's going to be a liability account, and it's unearned revenue. So they receive cash. Anytime you receive an advance payment and don't deliver services or products, you are going to record that as a liability, and in this case you are going to record a liability account called unearned revenue. We are going to continue with the next transactions in the next video.